Barrons Journal. We're breaking down the biggest business stories of the day, what happened, why it matters, and where the incentives really are. First article from Journal, Investing in Silver After a 30% Drop. Silver just had its worst day since 1980, and Barrons is calling it exactly what it is, a meltdown that might have set up a financial bonanza for the best-run miners. This matters because it sits right at the intersection of everything value investors care about: a volatile commodity, real underlying demand, scarce productive assets, and a group of operators whose cost structure and capital allocation will determine whether this is just another bubble or a decade of free cash flow. The article is from Barrons, and it opens with the simple observation that silver's Friday tumble is proof that what goes up must come down, even in the financial markets. But the question it tackles is more interesting. After a 31% collapse in one day, is the smarter long-term bet the metal or the businesses that pull it out of the ground? Start with the scoreboard. In 2024, silver was basically at break-even for the mining industry. In 2025, the average silver price was around $40 an ounce. By early 2026, prices had gone vertical. Through Thursday's close, silver was up almost 50% year-to-date, trading at about $100 an ounce, and had tripled over the past year, hitting as high as $120. Then, in a single week, especially on Friday, it all broke. Silver dropped 31% in one session, down to $85 an ounce. That is $35 off the recent high in a day after a tripling in 12 months. On the equity side, the largest silver mining ETF, the Global X Silver Miners Fund, with about $6 billion in assets and ticker SIL, had ridden the wave too. It was up about 20% this year through January 29th. Then the same volatility that hit the metal hit the ETF. It fell 14% on Friday. So you have this setup: a commodity that's been on a tear, a miners ETF that lagged the metal on the way up, and then a violent correction that took 31% out of the metal and only 14% out of the fund. That divergence is what Barrons is zooming in on. The article's core argument is that, while the risks are high, the bullish case for silver rests on three pillars: strong industrial demand, ongoing supply deficits, now running around 200 million ounces a year, roughly 20% of total demand, rising investor interest, particularly in Asia, where silver trades at a premium to New York and London. And then one more driver, the debasement trade. This is the idea that the dollar is structurally pressured by chronic federal deficits, potentially higher inflation, and a U.S. administration that is comfortable with a weaker greenback to help exporters. Other fiat currencies, the yen, the euro, are also losing luster. In that environment, investment demand for precious metals gets a tailwind. You can picture this as a wedge: industrial users pulling on one side, investors pulling on the other, and a supply base that's not easily expanded. Investment demand is itself multicausal, but the article frames the debasement story as the most important factor. That's what takes silver beyond just another industrial input and turns it into gold squared, as a Citigroup team led by Max Layton puts it. Gold on steroids. Is blunt. Silver is behaving like gold squared, and that likely continues until silver looks expensive by historical standards relative to gold. They put an upside target of $150 an ounce in the coming weeks. From 85, that's a near doubling if it plays out. Against that backdrop, Barrons asks a simple value question. If the metal has this kind of upside and this kind of volatility, where does a long-term owner want to sit in the stack? The answer it leans toward is the better silver miners. Look at the business economics the article lays out. Average all-in costs for the silver miners are in the $20 to $25 per ounce range. At $40 silver, in 2025, they were already profitable. At 85, even after the crash, you have $60 of gross margin per ounce if your cost is $25. At 100, you have $75. At 120, it was $95. The industry went from break-even in 2024 to a profitable 2025 when silver averaged 40 to what Barrons calls a likely financial bonanza in 2026. Profits should be up sharply from 2025 and from that 2024 near zero baseline. Wayne Lamb, a precious metals analyst at TD Cowen, calls the margin expansion and free cash flow unprecedented. His view, going into the drop, was that if the metal fell, the stocks would outperform. Friday's trading vindicated that. the ETF and the miners fell less than the underlying metal. That's operating leverage in action. When your cost base is relatively fixed in the short term and the sales price swings wildly, your margins move faster than the commodity, and often in a somewhat cushioned way on the downside because equities were already discounting some risk. Now, on screen, you see a photo from Mexico, a row of big haul trucks tipping silver-bearing ore into a primary crusher or onto a stockpile. Dust in the air, heavy equipment, the geometry of an open pit, or a large underground operations surface facility. That image is doing something important. It's reminding you that behind the ticker symbols, these are physical businesses: rock, fuel, people, permits. And right next to that, you see the key visual in this article, a table titled Silver Lining. It lists 6 companies across the rows, with multiple columns for each. Recent share price, 52-week percentage change, market value in billions, 2025 estimated EPS, 2026 estimated EPS, 2026 price/earnings ratio, estimated silver production in millions of ounces, silver as a percentage of revenue. Read it out slowly as if you're scanning it with your eyes. Kerr Mining, ticker CDE, at about $24.57 a share, up 286% over the past 52 weeks. Market value around $15.8 billion. Estimated EPS for 2025, 93 cents. For 2026, $1.61. That gives it a 2026 P/E of about 15.3 times. Estimated 2026 silver production, 20 million ounces, with silver about 20% of its revenue. First Majestic Silver, ticker AG, at $25.17, up 354%. Market value $12.4 billion. EPS estimates: 33 cents for 2025, 59 cents for 2026. That's a 42.7 times multiple on 2026 EPS. Rich, silver production estimated at 13.7 million ounces, with silver about 60% of revenue. Fresnillo, ticker FNLPF, at $54.07, with a staggering 544% 52-week gain. Market value around $39.8 billion. Estimated EPS, 1.65 in 2025, 2.81 in 2026. That's about 19.2 times 2026 earnings. Silver production, 44.3 million ounces, with silver around 44% of revenue. Fresnillo is the largest primary silver miner in the world by output. Hecla Mining, ticker HL, at $26.32, up 379% over the year. Market cap about $17.6 billion. EPS going from 38 cents in 2025 to 92 cents in 2026 for a 28.5 times P/E on 2026. Silver production estimated at 15.8 million ounces, 50% of revenue from silver. Pan American Silver, ticker PAAS, at $63.29, up 180%. Market value $26.7 billion. EPS estimates: 2.14 in 2025, 3.28 in 2026, giving a 19.3 times multiple. Silver production around 26 million ounces, with silver at 40% of revenue. And Wheaton Precious Metals, ticker WPM, at $152.70, with a 153% 52-week gain. Market value $69.3 billion. EPS estimated at 2.76 in 2025 and 3.81 in 2026 for about 40.1 times. Silver production. This one is a streaming business, not an operator. Around 21.5 million ounces in 2025, with silver about 50% of revenue. That table is doing several things at once. It's showing you that these stocks have already had massive runs, triple-digit percentage gains over 12 months. So this is not a deep value, nobody cares situation. It's also showing you how differentiated the exposure is. Some names, like Coeur, only get 20% of their revenue from silver. Others, like First Majestic, get 60%. Pan American sits at 40%. That matters, because silver is gold squared. If you're wrong on silver, a higher silver mix miner will suffer more on the downside, but also deliver more torque if the metal runs to 150. It's also giving you a sense of valuation. You have some names around 15-20 times forward earnings, others north of 40. And all of this is in the context of unprecedented macro volatility in the underlying commodity. Barrons then zooms back out to the structure of the industry. More than 70% of mined silver worldwide is not produced by primary silver mines. It comes as a byproduct of other metals, mostly gold. That means the universe of true primary silver producers is small, and therefore they have scarcity value. The article names 5: Hecla, Coeur, Fresnillo, Pan American, and First Majestic. Together, these 5 have a combined market value of around $110 billion. For context, that's less than just Newmont, the top gold producer. So if silver deficits persist, 200 million ounces a year shortfall, about 20% of demand and investor interest stays elevated, the set of companies that can actually turn that into direct revenue is tiny compared to the scale of the market. That's where scarcity value comes in. All of this sounds great for a long-term owner, until you remember that mining is a brutally hard business. The article doesn't sugarcoat that. There are operational challenges. Mines deplete, reserves have to be replaced. Permitting new projects is difficult in much of the world. Many silver mines are located in Latin America, where political winds can shift quickly. A change of government, a tax regime, a royalty law, any of that can take a project from high margin to marginal overnight. There is also the supply response risk. High prices tend to bring out marginal supply. Coin dealers are already seeing silver come out of the woodwork as Americans cash in family silverware. A single sterling silver 5-piece place setting contains about $400 worth of silver at current prices. If enough households start melting grandma's cutlery, you get secondary supply that can pressure prices. So the easy story, deficits forever, up only, is misleading. The lens Barrons applies near the end is the gold/silver ratio. This is a simple metric, gold price divided by silver price. Over the past 50-plus years, the average ratio has been about 65. In April, during the prior phase of the cycle, that ratio peaked above 100. Gold was very expensive relative to silver. As silver ran, outpacing gold over the past year, the ratio fell, getting as low as 45 recently. After Friday's silver plunge, the ratio jumped back above 55. That's still below the long-term average of 65, but a long way up from 45. What the article is hinting at is this: if silver's move was truly a blow-off that outran fundamentals, the correction in the ratio could be marking the start of a rebalancing where the worst of the silver froth is behind us. It's not a guarantee, but it's a data point. The large increase in the ratio on Friday could signal that the worst may be over. Now, put this all together as an owner. On the asset side, you have a metal with real industrial demand and structural deficits, a debasement tailwind from macro policy, a historical pattern of wild booms and busts. On the business side, you have a handful of primary producers with $20, $25 all-in costs, and massive margin expansion at current prices. A small total market cap, about $110 billion across the key 5 producers, operating leverage, rising dividends, and production growth potential. And on the risk side, you have country risk, permitting risk, and depletion, recycling and secondary supply, the possibility that a 31% down day isn't the bottom. The article's subtle recommendation is not buy everything with silver in the name. It is, if you want silver exposure after a 30% crash, miners might be the more rational, business-anchored way to play it. You get exposure to the debasement and industrial story, plus cash flows, dividends, and management teams who can allocate capital through the cycle. Each of the 6 companies in that silver lining table represents a slightly different bet structure. Coeur, big move already, but silver only 20% of revenue, more diversified, less pure silver torque. First Majestic, high silver percentage, high multiple. A purer silver play, priced like it. Fresnillo, largest producer by volume, significant silver share, huge stock move, scale, and leverage. Hecla, half its revenue from silver, strong move, high PE. Levered mid-cap. Pan American, balanced, sizable production, 40% silver revenue, diversified precious metals operator with silver upside. Wheaton, streaming model, no operating mines, 50% silver revenue, higher multiple exposure to silver without direct operating risk. For a compounding-focused investor, the interesting question is not which one will go up the most if silver hits 100. And 50, it's which of these has the management, balance sheet, and asset base to survive the next down cycle and still be around, with more ounces, 5 or 10 years from now? Because silver will not go up in a straight line. The article just gave you a history-making down day as proof. 3 lessons stand out from this Barrons piece. First, incentives and policy drive flows into precious metals, more than any single chart does. Chronic deficits, a government happy to see a weaker currency, other fiat options losing their shine. That's the real engine behind the debasement trade, not just fear. Silver rides that engine with more volatility than gold. Second, scale and scarcity matter. When more than 70% of mined silver is just a byproduct of something else, the small number of true silver miners capture an outsized share of the upside when deficits persist. Third, success plants the seeds of failure when you forget that mining is not a spreadsheet, it's a political and physical business. Permitting, local politics, depletion, and recycling are all waiting in the wings to show up the moment prices look too good to be true. If you treat these companies like leveraged ETFs instead of operating businesses, you will eventually get taught the difference the hard way. So the core question this Barron's article is really asking is not will silver hit 150? It's, after a 31% crash in a day, do you want to own a volatile barrel of metal? Or do you want to own the scarce cash-generating franchises that can turn a chaotic price strip into years of free cash flow, while everyone else is still staring at the chart? And the line to remember is this: in a market where silver itself trades like gold on steroids, the real edge belongs to the investor who lets the miners absorb the volatility and just keeps compounding the cash they spin off. Moving to next title, S&P Global, more than the sum of its parts. Barron's is making a simple claim. The parent, S&P Global, has been quietly compounding earnings, free cash flow, and data assets, while the market has barely moved the stock, just a 5% gain last year. In a world obsessed with AI names, S&P Global was treated as not AI enough, when in reality the whole model is built around proprietary data, benchmarks, and tools that are exactly what AI needs to feed on. The central figure in this story is Martina Cheung, S&P Global's CEO. Her role is very clear. She's the builder of a modern data and analytics platform that happens to own some of the most important indices in the world. She's the allocator of capital into private market data, credit ratings, and AI capabilities. And she's also managing the constraint of perception, the market's willingness to pay a multiple for a business that looks old world on the surface. At the company's investor day, she put a number on what truly drives this business. Over 95% of S&P Global's revenue comes from proprietary benchmarks, data, and tools, not generic data. Proprietary, that ownership is what gives them leverage in the AI era. Those data sets can be licensed to third-party AI players. They can be piped into models. They can be wrapped in their own generative interfaces. Her framing is interesting. AI players are an additional distribution channel that can improve economics with customers. She's not positioning S&P as a pure model company. She's saying, we own the inputs everybody else needs. At the same time, the company has been building its own generative AI and agentic capabilities because clients are asking for them. They've offered machine-readable data feeds since 2020. S&P recently agreed to acquire With Intelligence for $1.8 billion. With Intelligence is a data provider focused on private credit funds and other alternative investments. That's not a random bolt-on. Private market data is fragmented, hard to source, and highly proprietary. You can't scrape it easily. Brian McKnight, an analyst at Tocqueville, puts it simply. That kind of data is all highly proprietary information you can't necessarily scrape from the internet. And there are synergies to unlock with S&P Global's existing private markets datasets. The acquisition brings over 3,000 customers and about $130 million in incremental revenue. Post-deal, S&P's private market dataset will cover 60 million companies. Think about that. 60 million private entities tied into a platform that already powers ratings, indices, and public company analytics. That's raw fuel for every AI use case in finance. Now let's talk about what has actually worked inside this company. While the multiple drifted down, S&P Global is New York-based, founded in 1917 by James McGraw and John Hill. It is not a recent high-growth story, but the numbers look like 1. Since 2002, it has expanded EBITDA margins by 1.8 percentage points a year. That's not revenue growth, that's margin expansion, driven by operating leverage and cost discipline. Diluted earnings per share have grown at a 17% compounded annual rate since 2000. Consensus expects EPS to increase another 14% in 2025. Free cash flow is even more impressive, a 30% compounded growth rate since 2022. For a decade, this has been a reliable generator of free cash flow, dividends, and earnings. The company runs a formal capital return framework. It aims to return 85% of free cash flow through dividends and share repurchases. That's a clear decision rule. Most of what they generate goes back to owners, after funding whatever growth they believe in. Yet despite all that, the stock only rose about 5% last year, because it was seen as insufficiently AI-aligned. That's what quietly stopped working. The market's willingness to pay a high AI-like multiple for a business that doesn't shout AI in its ticker, even though its economics are rooted in the very data AI needs. So what is changing now? Barrons presents two valuation lenses, each essentially saying the same thing. If S&P Global just keeps doing what it's already doing, the stock could be 35% to 40% higher than where it trades today. First, a discounted cash flow view. Take S&P's own weighted average cost of capital at 8.1%. Assume a modest 1.5% perpetual growth rate on a terminal value of $181.5 billion. Run that DCF. It yields a target share price of $722, about 35% above the recent close of $527.79. Second, a multiple re-rating scenario. On screen, you see a small data box summarizing S&P Global. Ticker SPGI NYSE listed. 52-week change, about 1.5%. Market value, $164 billion. 22,006 estimated sales. 22.6 estimated P/E, 26.4. Right below it, a stock chart, 22,000, 25, 22,006, along the horizontal axis, share price along the vertical axis from $300 to $600. The line trends up from the low 300s toward the mid-500s, but with enough flattening to justify the rough patch narrative. Then there's a photograph of the S&P Global sign in office, with a caption noting that the company, founded in 1917, has been developing generative AI and agentic capabilities. Visually, it reinforces the idea that this is an old institution quietly wiring itself into the new stack. Relative to Moody's, the other public credit rating giant, S&P Global trades at a discount. Its forward P/E is about 26.5 versus its own 5-year average of 39.7. That's a 16% discount to Moody's multiple. Last July, the discount was closer to 20%, so the gap has narrowed, but it's still meaningful. On free cash flow, S&P Global yields about 3.6%. The company is expected to have repurchased around $5 billion of its own shares for 2025, which is about a 3.1% return through buybacks alone. Combine that with the dividend, and you're in the 6%, 7% total cash return yield range, while earnings are compounding double digits. That's the capital allocation story. Generate high-margin cash from data, benchmarks, ratings, and analytics. Reinvest in targeted growth areas like private market data and AI tools. Return roughly 85% of free cash flow through dividends and repurchases. The trade-off is clear. They're not hoarding cash or betting the farm on a moonshot. They're letting owners share the compounding now, while still funding things like the With Intelligence acquisition. Of course, Barrons doesn't pretend there's no risk. Geopolitical volatility can reduce debt issuance. If conflict or uncertainty spikes, companies issue fewer bonds, and that hits the ratings business directly. The same volatility can depress equity prices, which would hurt the S&P Dow Jones Indices unit's revenue. Many index products are fee-based on assets under management. Tariffs are another indirect risk. In the company's third quarter 10Q, S&P Global reported that manufacturers have reduced discretionary budgets in response to tariff uncertainty. That can impact spending on data products and analytics tools. Those risks are external, but they matter for a business that sits at the crossroads of capital markets, trade flows, and corporate investment cycles. So what are the lessons here for long-term owners? First, incentives shape how a business like this evolves. S&P Global's revenue model is tied to issuance, index usage and data licensing. Lower rates and a big maturity wall incentivize companies to refinance. Private credit growth incentivizes investors to pay for better data. AI players need proprietary feeds and will license them. Chung and her team are aligning the business with those incentives. More private market coverage, more machine-readable feeds, more generative interfaces. Second, scale can be a disadvantage if the market stops believing your story, but only temporarily if your economics are real. This is a $164 billion company trading at a discount to its own history and to Moody's, after a year where it still grew EPS and free cash flow at robust rates. The scale is not the problem. The perception is. If the company keeps expanding EPS at mid-teens and free cash flow at closer to 30%, the gap between 26x and 39x is likely to close over time. Third, success plants the seeds of complacency when investors treat the index as the product and ignore the platform behind it. Everyone knows the S&P 500. Few study S&P Global's mix of ratings, indices, and private data. That's how you end up with a world where the biggest AI winners trade at nosebleed multiples, while the company that owns the benchmarks, feeds the models, and rates the bonds gets parked at 26 times. For a patient owner, that's exactly the setup you want. A fundamentally strong compounding machine temporarily mispriced because it doesn't fit the narrative of the moment. So the core question this Barrons piece is really asking isn't, is S&P Global a good business? The numbers already answer that. The real question is, do you want to own the thing everybody looks at, the index, or do you want to own the company that quietly charges rent on the data, the benchmarks, and the ratings that make modern capital markets work? Because if S&P Global keeps doing what it's been doing, growing EPS mid-teens, expanding margins, returning 85% of free cash flow, then the sentence to remember is this: in a market obsessed with owning the S&P 500, the real edge belongs to the investor who owns the company that gets paid every time the world uses that benchmark to move capital. Moving to next title, The World of Dan Ives. Less well known is his growing set of overlapping business interests. That line from Barrons captures the tension in a single sentence. This isn't a story about whether Dan Ives is smart or whether AI is real. It's a story about what happens when the person who is supposed to be your lens on reality becomes a brand, a product, and a capital allocator in his own right. And when those roles start to collide, the question for any serious investor is simple: whose incentives am I really relying on? Dan Ives is the central figure here. On paper, his day job is straightforward. Based in New York, he's the global head of tech research at Wedbush Securities. That means he's responsible for writing equity research on some of the biggest names in technology, often within minutes of news breaking. For 25 years, he has built a record based on industry knowledge, credibility, and work ethic. Former colleagues describe him as genuine, enthusiastic, kind, generous. But on top of that core role, he's built something else: a mini conglomerate of personal ventures, all tied to the same themes he covers for clients. He is chairman of a tech company, 8Co Holdings, that buys cryptocurrencies to help fund Sam Altman's ambitions of verifying humans on the blockchain. He advises another public company, Zeta Global, which competes with Salesforce selling marketing tech tools. He's the pitchman for the Danforth Wedbush AI Revolution ETF, an exchange-traded fund that holds 30 big companies in the artificial intelligence space. He's even the face of a colorful clothing line. And he has become media. He wears pastel and highlighter-colored suits, baseball caps, and sunglasses to host investor panels. He has a cameo on Last Week Tonight with John Oliver. He appears on CNBC, Fox Business, CNN, Bloomberg, Yahoo Finance, constantly to talk tech. He has more than 230,000 followers on X, where he posts a steady stream of AI revolution commentary. On screen, imagine a montage, TV screenshots from those channels, each with Dan Ives, Wedbush in the lower third, him in bright suits, gesturing as he talks about Apple, Microsoft, NVIDIA. Next, his X profile, a bio listing some of his roles, a follower count north of 230,000, a feed full of bullish AI talk. That's the public persona Barrons is dissecting. What worked for a long time here was straightforward: a hardworking analyst, deep in tech, vocal and optimistic, who helped investors frame the opportunity. Wedbush benefited from his visibility. Media outlets got good sound bites. Clients got quick readable takes. The problem is, what quietly broke as the AI cycle kicked into another gear: the separation between research, promotion, and personal stakes. FINRA, the industry's self-regulator, has rules that prohibit analyst conduct where the conflicts are considered too pronounced to be cured by disclosure. Firms must disclose analysts' conflicts and limit activities that could compromise objectivity. Against that baseline, look at Ives's overlapping roles the way Barrons lays them out. He's a ratings analyst on stocks like Apple, Microsoft, Palantir, names that sit in his own branded AI ETF. The Dan4ES Wedbush AI Revolution ETF, launched last June, tracks 30 stocks he sees as defining AI's future. Since inception, it's up 30.5% versus 21.7% for the Nasdaq Composite. The holdings include companies he covers, like Apple, Microsoft, and Palantir. Nvidia is also in the fund, though a colleague covers it. Oracle, which Wedbush doesn't cover at all, is in the mix too. The ETF crossed $1 billion in assets within 6 months of launch. Attaching an analyst's personal brand to an ETF that directly holds the names he covers is highly unusual. Securities lawyers like Adam Ganna say they haven't seen many cases like it. Academic experts like Mark Bradshaw at Boston College, who has written a book and dozens of studies on sell-side research, say they don't know of any scenario where an analyst is simultaneously this embedded in multiple roles, tied to the same sector he's paid to evaluate. Bradshaw's concern is simple and blunt. There are different kinds of sources of bias, and the obvious one here is financial interest. If you are associated with a fund that benefits when the stocks you cover go up, there is a structural incentive to be bullish. Layer on his board and advisory seats. As chairman of 8Co, a digital assets firm, he traveled to Capitol Hill to advocate for AI and crypto, the same industries he covers for Wedbush clients, supposedly in an unbiased way. He advises Zeta Global, a marketing tech provider that competes with Salesforce, another tech name investors care deeply about. Now imagine the capital allocation incentives. Every dollar that flows into the Dan4's ETF increases its fee base. Bullish media appearances that attract more attention to AI names can boost flows. Positive ratings and price target hikes on holdings can support prices and sentiment. Advocacy in Washington for AI and crypto can support the revolution narrative underpinning all of this. At the same time, his X feed is relentless. He regularly talks up the AI revolution, often with little contextual disclosure under each post. Some roles are noted in his bio, but individual posts, where retail investors increasingly live, often don't carry the nuance. That's what Barrons is pointing to when it says the details are missing at a moment when investors are scrambling to distinguish hype from reality. As an analyst, he's expected to weigh risk and reward. As an ETF pitchman, his economic interest leans toward optimism. As a chairman and advisor in AI and crypto-linked firms, his reputation and equity stakes likely benefit from a hotter narrative. As a media personality and clothing line frontman, his personal brand thrives on energy, color, and bullishness. The party is just getting started. He has even put philanthropic capital into that narrative. In 2024, he and his wife committed $100,000 to Penn State to create the Dan and Robin Ives AI Innovation Initiatives Fund. In interviews, he insists, "This is not a bubble. This is the start of the fourth industrial revolution." That's conviction. But conviction plus overlapping economic interests is exactly where a value investor has to slow down and ask, who is this conviction serving? Barrons also reminds you of his path. Wedbush hired Ives in 2018 from a marketing consultancy to expand its tech research franchise. Before that, he spent 16 years at FBR Capital Markets, now B. Riley Securities. Along the way, he spent a year as head of investor relations at Synchronos Technologies, a New Jersey-based tech company. Synchronos's accounting practices were later investigated by the SEC. Ives was part of a 22 settlement with the commission. According to SEC filings describing that settlement, he was fired from the Synchronos job in 2017. That history doesn't invalidate his current work, but it adds another dimension. He has been inside the issuer side, in IR, at a company that later faced accounting scrutiny. He's lived the tension between story and numbers from both sides of the table. Now look at the visual Barrons builds. On screen, you'd see a collage of Ives on CNBC, Fox Business, CNN, Yahoo, Bloomberg. Lower thirds identify him as Wedbush analyst. Over that montage, you'd see a headline block in big type, Dan Ives Inc. Under it, in all caps, the Wedbush analyst has gone mainstream as Wall Street's highest-profile stock analyst. Less well-known is his growing set of overlapping businessy interests. That layout is telling you that the subject here isn't just one man, it's the transformation of a research franchise into a personality-driven marketing machine. Wedbush, for its part, defends him strongly. In a statement to Barrons, the firm calls out his exceptional 25-year record built on deep industry knowledge, credibility, a strong work ethic, and most importantly, unwavering integrity. They suggest the reporting could be conflating distinct matters. Former colleagues echo that he's phenomenally good, genuine, enthusiastic, kind. Those character references matter. But they sit alongside FINRA's rules about conflicts too pronounced to be cured by disclosure, and experts' observations that this mix of roles is highly unusual and possibly at odds with those rules. Barron's reporters reviewed regulatory filings, spoke with more than a dozen securities lawyers, researchers, and former regulators. Wedbush declined to make Ives or other executives available for interviews. Ives didn't respond to multiple emails. During the reporting, he blocked 2 of the journalists on X. That's another data point. When a key information provider blocks questions rather than answering them, it tells you something about how open they are to scrutiny. So what are the lessons here if you're thinking as a long-term owner, not as a TV viewer? First, incentives shape research as much as insight does. A sell-side analyst with one job cover companies for clients is already under pressure from banking, trading, and corporate access dynamics. Add an ETF, with his name on it, board seats in the same sector, and a personal clothing brand built on an optimistic persona, and the incentive structure tilts heavily toward bullishness and visibility. That doesn't automatically falsify his calls, but it means you cannot take them at face value without adjusting for that bias. Second, scale becomes a disadvantage when your brand eclipses your role. Dan Ives has scaled his visibility. TV, social media, ETF branding, Capitol Hill. That scale is a moat for him personally, but it can become a liability for investors who confuse fame with objectivity. When your broker is best known for employing Dan Ives, as Barrons puts it, you have to ask whether the firm is optimizing for research quality or for distribution reach. Third, success plants the seeds of failure when it blurs the line between analysis and marketing. For years, being early and bullish on tech made Ives a go-to voice. That success then made it easier to launch a Dan Frez-branded ETF, to sit on boards, to pitch AI and crypto on Capitol Hill. But the more those ventures depend on the same upbeat narrative, the harder it becomes to step back and say, this is overhyped, or this stock is a sell. The structure punishes skepticism. The core question Barrons is really raising isn't, is Dan Ives a good person? They quote plenty of people who say he is. The question is, when you outsource part of your decision-making to a high-profile analyst who is also a product, a fund brand, a board member, and a cheerleader for the same themes you're trying to evaluate, are you truly getting independent research? Or are you just getting marketing that happens to speak your language? And the sentence I'd keep in mind is this: whenever the analyst becomes the story, you have to double-check whether their research is still a tool for your compounding, or whether your capital has quietly become a supporting character in their personal franchise. Moving to next title, Barron's stock picks beat the market in 2025. A 10.4% return doesn't sound like much, until you realize the benchmark you're measured against did 9.2%. That's the core of Barron's stock pick story for 2025. In a year defined by Trump's Liberation Day tax cuts, an AI-driven stock market, and a rate rally that dragged bonds back from the brink, a simple, disciplined stock selection process beat the S&P 500 by about 1.2 percentage points. In a single year that doesn't change your life. Over a decade compounded, it does. This article is from Barrons, and it's about process, about how a set of out-of-the-box calls, Sphere Entertainment, Amphenol, Paramount, Skydance, plus some very ordinary names, like Dollar General, added up to quiet outperformance. There isn't a single founder hero here. The central decision-makers are Ben Levisan and the Barron's editorial team that sets the annual stock picks. They're not running companies. They're running a selection process. Their role is to act as builders of a portfolio and allocators of reader attention, under the constraint that they make public, time-stamped calls once a year and live with the scorecard. What worked for them for a long time has been a willingness to go against the grain. buying names that look messy when the story is fixable, leaning into unloved sectors when the incentives are shifting, and not trying to guess macro perfectly. What quietly stopped working last year, in their own telling, was the idea that you could just ride the most obvious AI winners and expect to beat the index. Instead, they found their edge in places where the market's narrative lagged the economics. Let's talk about the setup. In 2025, the dominant theme was AI, but value wasn't only in the obvious AI names. Trump's tax cut helped U.S. stocks overall. Bonds staged a powerful rally as the economy avoided a hard landing. Oil had moments where it looked like either a haven or an ultimate risk asset. There was plenty of macro. They recommended it on August 8th, immediately after the completion of a major event, Bausch Health's spin and new structure, and argued that the new company was set up as a straightforward, focused eye health business. The stock then climbed 28%, beating a 17% gain for the benchmark. Again, the edge came from stepping into a situation where complexity had just been reduced and the market hadn't fully repriced it. Then there's Sphere Entertainment. They told readers to buy Sphere, which operates the high-tech Sphere Theater in Las Vegas, on May 9th. At the time, Sphere looked like a speculative project, a giant, expensive entertainment globe, more spectacle than business. Barrons argued it was worth more. They were right. Sphere stock gained about 193%, trouncing the S&P 500's 24% over that same stretch. The Sphere became a fixture in Las Vegas, and the parent company's unique asset, one-of-a-kind experiential infrastructure, was finally appreciated. On screen, imagine the illustration Barrons used, a stylized sphere sitting next to a Chevron logo, EpiPen-like drug vials with labels for blockbuster meds, an airplane, a rating sheet with stars, and a mountain globe. It's a collage of assets, energy, pharma, media, travel, showing that the picks came from across the market, not just one sector. Another winner, MSGS, the owner of the New York Knicks and Rangers. They recommended Madison Square Garden Sports in April 2019 and reiterated it in 2024, arguing that the underlying sports franchises were undervalued. In 2025, MSGS beat the index again, as demand for premium sports content and franchise scarcity drove valuations higher. Owning irreplaceable assets, a top NBA team, a storied NHL franchise, proved once again to be a good long-term bet when bought right. They leaned into AI infrastructure too, but not by chasing the most obvious chip headlines. They recommended Amphenol, a maker of connectors, cables, and other electrical components that power all the electronics beneath the AI hype. The idea, AI data centers and devices can't function without high-reliability connectors and interconnects. As the AI narrative exploded, Amphenol rode the hardware demand. The stock, as they note, did very well, outperforming the index meaningfully. Similarly, Arista Networks, a networking company with exposure to high-speed data center switching, was up about 38% after being recommended in June. That beat the S&P 500 by a wide margin. The logic was again about plumbing. AI's demand for compute implies exponential demand for bandwidth and low-latency networking. They also found value in cyclically depressed areas like cruise lines. They recommended United Airlines-linked cruise operator Viking Holdings, or in the article's specific example, a listed cruise line that had recently come public. That stock gained 67% or more against an 11% benchmark gain in the same window. The thesis: pent-up travel demand, more affluent customer cohorts, and better pricing power than the market assumed. Not every call worked. They recommended some plays that underperformed, names in consumer and media that were cheap for a reason, situations where management execution lagged or the macro thesis didn't come through fast enough. They highlight Pinterest and Farmerica-like names where they had expected more upside but only got mid-20s or high 30s returns. Good, but not benchmark beating. They also concede one or two picks where they were flat out wrong, like overestimating a tech or retail turnaround that never showed. That's important. Process that never admits error is marketing, not investing. Here, they catalog both the winners and the laggards. Under the surface, the inflection points share a pattern. Sphere, a misunderstood asset-heavy entertainment platform, proves its economics. Dollar General, operational issues get addressed. The concept proves resilient. Bausch plus Lomb, Spin-out clarity lets the market re-rate a newly focused franchise. NSGS. The market slowly realizes sports assets are trophy properties. Amphenol/Arista. AI hype translates into real hardware orders. In every case, there was a moment where what worked quietly stopped working for the prior owners. Sphere looked like a money pit. Dollar General looked broken. Bausch looked messy. MSGS looked like a complex Dolan structure. Amphenol looked like boring industrial. Those moments are exactly where a patient, fundamentals-driven picker earns their edge. On screen, the headline reads, Barrons stock picks beat the market in 2025. With a subhead, out-of-the-box thinking and good timing yielded a roster of winners such as Sphere Entertainment, Amphenol, and Paramount Skydance. The first letter of the piece, an ornate dropcap A, sits next to a paragraph explaining that a little chaos can be very good for stock picking. That's the thesis. 3 lessons for long-term owners come through clearly. First, incentives shape outcomes. Wall Street is paid to sell what's working. Year-end lists usually overweight the past year's winner. They explicitly acknowledge that some long-time favorites were no longer working in 2025. Barrons took names off its winners lists, admitted where the thesis had stalled, and recycled capital into fresher setups. That's what you want to see. Not loyalty to an old narrative, but loyalty to compounding. So what's the core question this Barrons article is really asking? It's not, can you beat the S&P 500 every year? It's, in a world where the index gives you almost everything, is there still a role for concentrated, reasoned stock picking? Their 2025 answer is yes, but only if you're willing to buy into discomfort. Think in terms of business inflection points and accept that a 1% or 2% edge, repeated over years, is what builds real wealth. And the line I'd leave you with is this. In a market obsessed with chasing the loudest winners, the quiet edge still belongs to the investor who can look at a messy story, see a fixable business, and hold it long enough for the numbers to prove them right. Moving to next title, the best active small-cap ETFs. Actively managed small-cap ETFs often beat their indexed counterparts. But investors still haven't really shown up. That tension is the heart of this Barrons article. In large caps, the active game is mostly over. Cheap index funds won. But down in small caps, where information is messy and liquidity is thin, the pattern repeats over and over. Thoughtful active processes beat the benchmark, yet the money chases the lowest fee instead of the highest after-fee return. For anyone serious about compounding, that's a mispricing of process. The central figures here aren't founders in the Silicon Valley sense. They're portfolio architects. People who build and maintain small-cap strategies in a part of the market where decision-making still moves the needle. The team behind First Trust Multi-Manager Small-Cap Opportunities. The quant crew at Avantis running US. Small Cap Value. Fidelity's quantitative enhanced ETF division behind Fidelity Enhanced Small Cap. Rag & Stinky at Ballast Small/Mid Cap. An old-school stock picker running a concentrated ETF. Their roles are clear. They're builders of different kinds of engines. Multi-manager, factor-based, rules plus discretion, deep fundamental. They're allocators of capital into hundreds of tiny companies that most index buyers have never heard of. They're constrained by capacity, liquidity, and front-running risk in a way that S&P 500 index managers simply aren't. What worked for a long time in ETF land was simple. Make it cheap, make it transparent, track the benchmark, and let scale do the rest. That playbook quietly stops working when you move into less efficient parts of the market, like US small caps, where information is scarce and liquidity is thin. That's where this article lives. Start with the example Barrons opens with, First Trust Multi-Manager Small Cap Opportunities ETF. 3-year annualized return, 19.3%. That's not a backtest. That's live. Its small growth peers averaged 12.3% over the same period. The Vanguard Russell 2000 Growth ETF, a straightforward indexed small growth fund, delivers 15.0%. So First Trust is beating its active category by about 7 percentage points a year. Vanguard's index product by about 4.3 points a year. And yet the First Trust Fund has only $41 million in assets. Its expense ratio is 0.95% versus Vanguard's 0.10%. The investor's mind says, I want cheap. The math says 19.3 minus 0.95 still beats 15.0 minus 0.10. By a wide margin, On screen, picture a small table with 3 rows. First Trust Multi-Manager Small Cap Ops, 19.3%. 0.95% expense, 207 holdings, 41 million in assets. Category Average Small Growth Fund, 12.3%. NDU_line, Vanguard Russell 2000 Growth, VTWG, 15.0%, 0.10% fee, 1,117 holdings. Avantis US Small Cap Value is an active quantitative ETF. It keeps costs low by using computers to select hundreds of stocks, but it's not a simple rules-based smart beta that rebalances on a fixed calendar. Fees, 0.25%. That's just a hair above the 0.24% charged by the indexed iShares Russell 2000 Value ETF. Assets, $22 billion. Investors have piled in because the track record is undeniable. 5-year annualized return for Avantis AVU, 13.7%. New_line, 5-year return for iShares Russell 2000 Value, 8.4%. That's a 5.3-point annual edge in a part of the market that is usually considered efficient enough that you're supposed to take whatever the index gives you. The Avantis ETF holds around 780 names. The table shows 780. The text mentions 778. That breadth crushes capacity issues. As co-manager Matthew Dubin says, with over 700 names, you can invest quite a lot of money. In that structure, what matters isn't whether you nailed a single stock. It's whether your screening for value and profitability across hundreds of names is systematically better than the benchmark. Front-running risk is low because the portfolio is so diversified, no single name moves the needle. Dubin's filter is crisp. For a stock to pass their screen, it has to have a good price and be highly profitable at the same time. Close to 40% of small-cap companies have negative earnings. Many of them are cheap because they're value traps. AVUV simply says, we don't need them. They also avoid fixed trading schedules. Instead of rebalancing everything on the same day every quarter, they are cost-conscious, waiting for an opportune time to buy or sell in illiquid names. A simple, smart beta ETF, by contrast, might mechanically buy at whatever price the market offers at a quarterly rebalance. That difference in trading behavior, timing, patience, cost sensitivity creates a lot of hidden alpha in micro and small caps. Now look at Fidelity Enhanced Small Cap, ticker FESM. This is another quant-enhanced active ETF sitting in the small blend category. It holds roughly 600 stocks, charges a 0.28% expense ratio, and has about $3.8 billion in assets. 5-year annualized return, 9.9%. Compare that to the average small blend fund at 7.4%. New_line, Vanguard Russell 2000 VTUO at 5.8%. Again, you're beating the category by 2.5 points and the raw index by 4.1 points a year. After a modest active fee, Mike Hagopian, who manages in Fidelity's quantitative enhanced ETF division, explains the core difference between their approach and old-school smart beta. Smart beta is rules-based, often static. You define factors once, value, quality, momentum, and then follow them mechanically. Enhanced quant is dynamic. Fidelity has a dedicated research team whose full-time job is to keep looking for new data sets, new characteristics, new factors that actually deliver alpha over time. They're not just rebalancing to the same book-to-price screen every quarter. They're evolving the model as markets evolve. That evolution is itself a form of capital allocation. You're constantly reinvesting research time and data dollars into better signals. Finally, you have Ballast Small/Mid-Cap ETF, MGMT, which is almost the opposite of Avantis in construction. Ballast holds just 53 stocks. Expense ratio, 1.10%, the highest in the group. Assets, about $166 million. 5-year annualized return, 11.1%, beating 92% of its small blend category peers. Manager Ragan Stinky is described as an old-school stock picker. He likes companies like Brinks, the security firm that's pushed beyond armored trucks into more lucrative services, and Climb Global Solutions, an IT and software company. This is pure fundamental work. Pick 50-odd names, know them deeply, Accept the concentration, charge for the effort, and aim to be right often enough that even after a 1.10% fee, the investor is rewarded. The capacity constraint is visible. At 166 million in assets, life is easy. But what happens at 3, 5, or 10 billion if you're trying to move in and out of thinly traded small caps? Stinke has an answer. What we intend to do with our ETF is to simply quit marketing the strategy once we get to about $3.5 billion. In our experience, that tends to keep assets relatively flat. That's a deliberate decision to cap growth, recognizing that scale can become a disadvantage in small caps. You can't gather infinite assets without hurting your own performance by becoming the market in your names. On screen, Barrons gives you a comparison table. Active ETFs, Avantis US Small Cap Value, AVUV. Small Value Category, 12.3%, 3-year, 13.7% 5-year, 0.25% fee, 780 holdings, 21.9 billion in assets. Ballast Small/Mid Cap, MGMT, Small Blend, 13.3% 3-year, 11.1% 5-year, 1.10% fee, 53 holdings, 166 million assets. Fidelity Enhanced Small Cap, FSM, Small Blend, 18.1%, 3-year, 9.9% 5-year, 0.28% fee, 607 holdings, 3.8 billion assets. First Trust Multi-Manager Small Cap Opportunities, MMSC, Small Growth, 19.3%, 3-year, N/a 5-year, 0.95% fee, 207 holdings, 41 million assets. Index ETFs, iShares Russell 2000 Value, IWN, Small Value, 11.5% 3-year, 8.4% 5-year, 0.24% fee, 1,417 holdings, 12.7 billion assets. Vanguard Russell 2000, VTUO, Small Blend, 13.5% 3-year, 5.8% fee, 1,978 holdings, 14.3 billion assets. Vanguard Russell 2000 Growth, VTWG, Small Growth, 15.0% 3-year, 2.8% 5-year, 0.10% fee, 1,117 holdings, 1.3 billion assets. That table, if you stare at it as an owner, is telling you something simple. In small caps, the right kind of active, whether diversified quant like Avantis and Fidelity, or concentrated stock picking like Ballast, has, at least in recent years, delivered meaningfully better long-term returns than the index, even after higher fees. The article also explains why active small-cap ETFs are structurally tricky. Most ETFs are transparent. They show their full holdings daily because investors like that. In large caps, that transparency is fine. In illiquid small caps, it invites front-running. Other traders can see what a manager is accumulating, get in ahead of them, push prices up, and then sell into the demand, raising the cost for the fund's existing shareholders. Capacity is another constraint. Mutual funds can close to new investors when they get too big. ETFs can't easily do that. They're open-ended vehicles by design. So an active small-cap ETF has to either build in enough diversification, hundreds of names, that capacity is less of an issue, or cap growth informally by stopping marketing once it reaches a size that would start to hurt execution. Avantis solves it with 700-plus names and a modest fee. Fidelity solves it with 600-plus names and an adaptive quant process. Ballast solves it with a willingness to stop selling the strategy at around $3.5 billion. First Trust solves part of it by splitting the mandate between two sub-advisors who can each handle a slice. The bigger reality check is this. Active managers have a better shot at beating their benchmarks in small caps precisely because small companies are priced less efficiently. Many aren't well covered by Wall Street analysts. Close to 40% have negative earnings and are cheap for a reason. There are genuine value traps. In that environment, doing the work, screening for profitability, trading patiently, evolving models, or doing old-fashioned bottom-up research actually matters. But investor behavior hasn't caught up. Money still flows mostly to the cheapest tickers. AVUV is a partial exception because it's both cheapish and excellent. But something like First Trust's MMSC with stellar 3-year returns and a 0.95% fee, sits at $41 million of assets. Tiny. Investors are anchoring on expense ratio rather than net outcome, applying S&P 500 logic to a part of the market where it doesn't fit. 3 lessons for long-term compounding jump out. First, incentives shape product design and flow. Third, success plants the seeds of failure if you freeze your process. The quant teams at Avantis and Fidelity emphasize evolution. They don't worship fixed smart beta rules. They adapt screens, datasets, and trading tactics as markets change. A static rule set in small caps becomes arbitraged away over time. A living research process is what keeps adding value. So the core question this Barrons article is really asking isn't, are small caps risky? We already know they are. The real question is, if there is any place left in public markets where active skill is still statistically beating the index after fees, are you willing to pay a fair price for that skill and to understand the constraints that protect it? Or will you reflexively reach for the cheapest ticker and leave that edge on the table? And the sentence I'd remember is this: in a market that has decided cheap beta is always enough, the quiet opportunity is in the few corners, like small cap ETFs, where paying modestly for real skill is still one of the simplest ways to change your long-term outcome. Moving to next title, The War on Defense Stock Dividends. Driven growth? Income investors are about to find out. That line, from Barrons, is the fulcrum of this entire discussion. For years, defense has been sold as the ultimate sleep-well sector. Steady government demand, oligopoly structure, predictable cash flows, dependable dividends, and buybacks layered on top. Now the question is whether that model survives when the commander-in-chief literally threatens your capital allocation if you don't deliver. The article is from Barrons, and the story it tells is about incentives colliding. The Pentagon wants more capability, faster, cheaper. The White House wants discipline and optics. Boards want to keep dividends and buybacks flowing. Investors want both yield and growth. And underneath all of that sits a simple number. Almost 90% of net income has been leaving these businesses as cash to shareholders. Let's set the stage. On January 7th, President Donald Trump signed an executive order aimed directly at the big U.S. defense contractors. The threat was clear. If you don't deliver innovative defense technologies on time and on budget, the government can restrict how you allocate capital. In other words, your freedom to use cash for dividends and buybacks is now, at least on paper, contingent on your performance for a single customer. The U.S. government. A little bit of math shows why that matters. Take the large U.S. defense contractors as a group, excluding Boeing. Boeing complicates the picture because it doesn't currently pay a dividend or buy back stock. The rest of the majors, think Lockheed, Northrop, RTX, General Dynamics, and peers, yield about 1.4% on average. Over the past 12 months, they've paid roughly $12 billion in dividends and bought back around $15 billion of their own stock. That's $27 billion out the door to shareholders. Now compare that to their earnings and reinvestment. Those payouts consumed nearly 90% of their net income and were roughly $3 billion more than they spent on new plants, equipment, and research combined. In plain language, almost every dollar of earned profit is being shipped to shareholders, with only a minority reinvested in the industrial base. On screen, imagine a simple bar chart, one bar labeled net income at 100 units. Next to it, a bar labeled dividends plus buybacks, rising to nearly 90 units. A third bar labeled CapEx plus R&D, sitting down near 27 units, 3 units lower than the payout bar. The picture tells you why a populist White House sees a target. These companies look like cash return machines more than they look like warfighting innovators. So Trump's order is, in form, a threat. But Barrons suggests it may actually be designed as a warning, something like, change your behavior, invest more in capability, or we'll start using the stick. RBC analyst Ken Herbert captures the nuance. He says, you can negotiate, you can cut a deal, and you can get yourself off the no-fly list. That line tells you this isn't an automatic guillotine. It's leverage. The government is using the threat of capital controls to push boards and CEOs toward more CapEx, more R&D, less financial engineering. How are the companies responding? Look at management commentary on recent Q4 earnings calls. Despite the executive order, there was no sign of imminent dividend cuts. Northrop Grumman's chief financial officer, Ken Cruz, was asked if they would continue paying dividends. His answer was one word: yes, 100%. RTX CEO Christopher Callio told investors, "We recognize our shareholders rely on our dividends, and they've come to expect our dividends. So, we remain committed to the dividend." That's important. Boards are drawing a line. The dividend is sacred, at least for now. They know that a reliable payout is part of the defense equity story. At the same time, they're promising higher capital spending. Defense companies have committed to ramp CapEx to expand and streamline manufacturing capacity across many programs. Spending in 2200 is projected to rise about 30%. That is a big step up. More investment consumes cash, but ideally it leads to more growth. Lockheed Martin's CEO Jim Taiclet lays out the logic. He says new contracting priorities at the Department of Defense are creating stable growth opportunities for companies. He adds that the expected returns from new investment will exceed Lockheed's cost of capital. That's exactly what you want to hear as an owner. We will put more money into factories and engineering because the incremental projects clear our hurdle rate. Lockheed has already announced plans to expand its PAC-3 Patriot missile system and its THAAD high-altitude missile interceptor program. Those are big, capital-intensive lines. Facilities, tooling, supplier capacity, all of that costs money up front. On-screen picture photos of the PAC, 3 missiles in canisters, and a THAAD launcher on a desert pad. Next to them, a caption, "Lockheed's announced expansions," signaling more CapEx and more future revenue. Visually, it tells you where the incremental dollars are actually going, into hardened steel, radar domes, guidance systems, not just digital buyback authorizations. Vertical Research Partners analyst Rob Stallard puts it bluntly: Lockheed, like its peers, basically has no choice but to invest if it is to participate in the growth trajectory that should be ahead. If you want to win future contracts, you must build the capacity now. The carrot here is that the growth trajectory for defense looks real. Barrons enumerates the tailwinds: rising geopolitical tensions, higher military spending in the US and Europe, the proliferation of new autonomous technologies, and the emergence of space as both an opportunity and a threat. Each of those is a multi-decade theme. Geopolitical tensions, Russia, Ukraine, Taiwan, the Middle East, all of these push NATO and allies toward higher defense outlays. US and European budgets, after years of underspending relative to commitments, governments are moving toward higher percentages of GDP on defense. Autonomous tech, drones, loitering munitions, unmanned surface vehicles, these require new sensors, communications, and control systems. Space, satellite constellations, anti-satellite weapons, missile warning systems, this is a frontier where legacy platforms don't suffice. Those forces are the backdrop for Trump's order. The state wants more capability. The question is whether it will tolerate 90% payout ratios while asking contractors to retool for a much more complex threat environment. From a value investing lens, here's the fascinating part. The executive order could actually make the stocks more attractive if it's interpreted as a push toward higher reinvestment with still safe dividends. Imagine the capital allocation equation shifting from net income equals 90% payout, 10% reinvestment, toward net income equals, say, 60% payout, 40% reinvestment, if, and only if, that 40% earns returns above the cost of capital. That's what Taiclet is hinting at when he says expected returns exceed Lockheed's cost of capital. If true, the market should reward that with higher intrinsic value over time, even if near-term reported free cash flow dips. Barrons notes that this corporate cooperation on CapEx could ease the government's ire about buybacks and executive pay. Put differently, if boards show they're putting serious money into capacity and innovation, the threat of hard capital controls fades. So where does that leave income investors, who just want to know if their dividends are safe? For now, management teams are making all the right noises. CFOs and CEOs are on record in earnings calls affirming commitment to dividends. There is no explicit rollback of payout policy in response to the order. Instead, the adjustment is happening on the reinvestment side. CapEx and R&D budgets moving up. Meanwhile, the sector itself has been strong. Wall Street's favorite defense contractors right now are GE Aerospace and L3Harris Technologies. Both have buy ratings from more than 70% of the analysts who cover them. Both have dividend yields north of 1%. That doesn't sound high compared with utilities or REITs, but in defense, the real attraction is total return, steady yield plus secular growth. Alternatively, investors can just buy the sector. The iShares U.S. Aerospace and Defense ETF, ticker ITA, is up about 52% over the past 12 months, roughly 37 percentage points ahead of the S&P 500. But IT yields only about 0.5%. That's the trade-off. Huge price performance, low income. On screen, picture a simple line chart with two lines. One, in dark blue, labeled ITA, climbing sharply over the year to a 52% gain. The other, in gray, labeled S&P 500, up a much gentler 15%. In a corner, a small box notes, yield. It is 0.5%, S&P 500, about 1.4%. Visually, it makes the point that in defense, you've already enjoyed a big re-rating. The income stream is modest, but the growth and momentum have been enormous. So what's the reality check? First, the executive order is a shot across the bow, not yet a torpedo into the hull. It threatens companies' ability to allocate capital freely, but hasn't yet forced cuts. The order's existence, however, is a reminder that in defense, your largest customer is also your regulator. If they decide your payout policy is politically unacceptable, they have tools. Second, the current payout math, $27 billion in dividends and buybacks, roughly 90% of net income, $3 billion more than CapEx plus R&D, is not sustainable forever in a world where you're simultaneously being told to innovate faster and expand capacity. At some point, either earnings rise enough to cover both, or the payout ratio trends down. Third, the growth backdrop actually argues for more reinvestment. Rising tensions, higher budgets, autonomous tech, and space all point in the same direction. The workload for these contractors is getting heavier, not lighter. Underinvesting in plants, equipment, and research while keeping payouts maxed would be the definition of success taken too far. For us, as long-term owners, 3 lessons stand out. First, incentives shape how capital gets deployed. Defense boards have been rewarded, for years, for returning cash quickly. The market cheered the combination of 1.4% yields, steady buybacks, and modest growth. Now the political incentive is shifting. The government wants more visible reinvestment. When your only real customer changes its priorities, your optimal capital allocation policy changes too. We should expect the best management teams to lean into that shift before it's forced on them. Second, scale becomes a double-edged sword when your main customer can weaponize it. These are huge contractors, essential to the national industrial base. That scale is a moat, but it also means you can't simply ignore Washington. An executive order aimed at large U.S. defense contractors is a reminder that your size makes you both systemically important and politically exposed. Smaller players might fly under the radar. The giants cannot. As investors, we have to price that regulatory overhang into our required returns. Third, success plants the seeds of regulatory backlash when payouts outrun reinvestment for too long. For years, defense companies consumed nearly all their net income in dividends and buybacks, while CapEx and R&D lagged. That looked fine as long as geopolitical risk was low and the public wasn't paying attention. Now, with wars, drones, space threats, and a populist administration, that pattern is suddenly unacceptable. The same behavior that once signaled shareholder friendliness is now framed as underinvesting in national defense. The core question this Barrons piece is really asking isn't just are defense dividends safe, it's, can these companies evolve from being high payout, modest growth utilities into businesses that still reward shareholders while genuinely investing enough to meet a much more demanding strategic environment? And the sentence I'd keep in mind is this: in defense, the best long-term returns will belong to the companies that treat Trump's order not as a one-off threat to their dividends, but as a forcing function to build an industrial base so strong that both Washington and shareholders can live with their capital allocation for decades. Now, towards last article, silver's rise has been historic. What to do now? Financial markets have a new attitude, exemplified by zero-dated options and prediction markets. Many people view the markets as a casino. That observation from Barrons cuts to the core of what's happening. For generations, investing was about buying low, selling high, and letting compounding do its work. Now the dominant pattern is hot gets hotter. fueled by retail traders, social media, and a willingness to bet big on momentum. Silver isn't just a commodity in this story. It's the poster child for the shift. This is from Barrons' The Striking Price column, and it's a warning disguised as a trade idea. The bigger point is how casino thinking erodes long-term discipline, and silver's wild ride is Exhibit A. The central figure here isn't a single founder or CEO, it's the collective behavior of retail investors, the new force in markets. They're the builders of this momentum machine. They're the allocators chasing what's working, ignoring what's cheap. They're the constraint on traditional investing, disproving old maxims like buy low and sell high with sheer volume and conviction. What worked for a long time was rational rotation, take profits on 100% plus winners, and redeploy into beaten-down names with recovery potential. That quietly stopped working as retail emerged over the past 5 years. The new mantra, what is hot can get much hotter, if enough people will it to be thus on social media. Meme stocks proved it. Hot stocks prove it daily. And silver is the mascot. The iShares Silver Trust ETF, ticker SLV, is up 287% over the past year. That dwarfs almost everything else. In early January, Barrons suggested preparing for SLV to hit record highs because precious metals showed a rare trait, price insensitivity. Investors were buying silver regardless of the price, often to offset geopolitical uncertainty. That call worked. Their trade returned more than 1,000% in less than 4 weeks. The position expires February 20th, but they encouraged taking profits early, which proved prudent. On Friday, SLV plunged 29%. For reasons not entirely clear, investors aggressively sold on news that Kevin Warsh was nominated to be the next Fed chair. The fear, he may be more hawkish on inflation, strengthening the dollar and pressuring precious metals. Over the past 52 weeks, SLV has traded from $26.57 to $109.83. It's up 17% year to date. That's extreme volatility. On screen, imagine the 4 charts Barrons shows. First, the CBOE Volatility Index, VIX Close and Futures. A line chart from last May through now, swinging between 12 and 54, spiking in summer and late fall. Now hovering mid-20s. It's measuring market fear, and the creator is saying volatility is elevated but not panicked. Second, the equity-only put-call ratio overlaid on the S&P 500. The ratio line bounces between 50 and 194, peaking when the S&P dips. High readings mean heavy put buying, bearish sentiment. These charts frame silver's move. Markets are volatile, sentiment is mixed, and hot assets like SLV can reverse fast. Now the inflection point. Past, price insensitivity. Investors buy silver no matter the level. Geopolitics as catalyst. Present. Fed nomination triggers fear of tighter policy, dollar strength, precious metals weakness. Copying the past, buying the breakout blindly, fails because macro catalysts can flip sentiment overnight. Evolution is unavoidable. You need a way to play momentum without unlimited downside. Barrons offers 1. A call spread on SLV. With SLV at $75.44, buy the March 80 call and sell the March 95 call for about $3.30 net debit. If SLV is at $95 at expiration, the spread is worth its maximum. $15 minus the 3.30 cost equals 11.70 profit. That's a 354% return on risk. If it expires below 80, the trade loses the full 3.30. Maximum loss is defined. This is a bull call spread. Long one call, short a higher strike. Same expiration. It limits risk to the debit paid. It benefits from upside. By selling the higher call, you offset implied volatility expense, the premium you pay for betting on a hot asset. Unlike owning SLV outright, losses are capped. Spreads cap profit too, but in sizzling names, the return can still be 100% or more. The autopsy of the recent trade. What was expected? SLV to record highs on geopolitics. What happened? It did, delivering 1,000% on their position. Opportunity cost, holding through the 29% plunge. Hidden trade-off, casino moves end fast. Most failures come from success carried too far, riding winners until they're no longer hot. Reality check time. Silver's 287% run is historic, but it's also a symptom of casino thinking. Retail power has made buy low, sell high feel outdated. Hot gets hotter on social media. Meme stocks showed it, yet volatility cuts both ways. Friday's 29% drop on a Fed nomination rumor reminds you that momentum can evaporate. Warsh's hawkishness could strengthen the dollar, hurting metals. What most people miss, traditional disciplines still work, but you need tools to navigate the noise. Zero-dated options. Prediction markets, they're casino innovations, but a call spread is a disciplined way to bet on hot without gambling the farm. 3 lessons for those who still believe in compounding. First, incentives have shifted. Retail traders are incentivized to chase momentum because that's where the short-term wins are. Institutions chasing benchmarks get dragged into it. As a value owner, your incentive is different. Survive the casino phase. Buy when it ends. The casino mindset challenges long-term investing because it rewards get-rich overnight over patient capital. Second, scale becomes a disadvantage when everyone piles into hot. SLV's 287% run drew everyone in. Then the reversal hit. What works in isolation, buying breakouts, fails at scale when sentiment flips. The smart play is defined risk, spreads over naked longs. Third, success plants the seeds of reversal. Price insensitivity felt like strength. It was overconfidence. The 1000% trade was success carried too far without an exit. Silver's plunge shows why. Markets don't stay irrational longer than you can stay solvent, but casino markets stay irrational until a catalyst flips them. The core question Barrons is raising isn't, is silver going higher? It's, in a world where markets feel like casinos, how do you position for momentum without becoming the house's next victim? And the sentence to remember is this: hot gets hotter until it doesn't, and the disciplined allocator survives by using tools that let you bet on the fire while keeping your capital ready for when it inevitably burns out. This is Avi. Like and subscribe. On to the next.